1, 2, 1, 2, 1, 2, 1, 2. We're currently looking at the Euro USD weekly chart. And we're going to have a look at some more time frame correlation to understand how price action moves on different time frames and highlight potential entries into the marketplace. We can see that all the way through 2011 through to the middle of 2012, on the weekly charts, the euro dollar was in a downward trend. That means we're looking to sell the lower highs as the market's moving to the downside. If we look, we can see here how the previous low can act as support, which can then become resistance on the next move to the downside. We can also see this support level, touch, 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 that gets reacted again and again and again. When price does break through, it then pulls back up to it again, and we see another opportunity to sell around here. We're going to be looking at both of these key areas, and I'm going to highlight those now so we can zoom in more detail. We're going to first of all be looking at the sell signal around here, but on a slightly smaller time frame, such as the daily chart. And again, we're also going to look at where the support becomes resistance again in this zone through here, and look at the potential entries into the marketplace. Bearing in mind the reason that we're looking at these specific opportunities are because the market is in a downward trend, we have lower swing highs and lower swing lows, and we have support becoming resistance on the way to the downside. There's one final one we're going to look at through here, which is this support becoming resistance towards the end of the trend here, and we'll highlight that one as well. So we can see there's three different places where we're looking to trade, and we'll actually now zoom into the first one over here and to have a look in a little bit more detail. Bearing in mind on this weekly chart, our stop loss, if we were to trade this, would be around 315 pips. So 315 pips is a particularly large stop. We want to see if we can bring that down to at least underneath 150 pips. So let's drill down now to the smaller time frame, the daily chart, and look at the price action when we look at the level there. So we've got our horizontal levels drawn in. And as we drill down to this zone, we can see I've now got this first gold box here highlighted at the first horizontal level. This was the one where the weekly charts gave us the potential signal that there was to be a reversal in price. If we look back at the weekly charts, we're looking at this area here where the support became resistance. If we go back down to the dailies, we can see how price has pulled up to this level, and there's an interesting price action pattern that we're going to be looking at here. We can see, of course, that price action did move quite strongly away from that area, and in the coming weeks move down very strongly to the downside. If we look at this first point here and look at the price action that's occurring around this level, bearing in mind that this level is a zone, so price could skip slightly through it because we're looking, of course, at a slightly smaller time frame now. We do a weekly horizontal level, and we're now looking on the daily chart. We can see here that we've got one inside candle followed by another inside candle. So we actually have a double inside candle formation here, or double inside bar formation, and that's followed then by an engulfing candle or an engulfing bar formation. So we have indecision, extreme indecision, followed by an extremely aggressive move telling us it's likely to move to the downside. Now, our first entry point into the market in this position would have been, of course, the first inside bar here, or the first inside candle. We see that the high and the low of this candle is inside the high and the low of the previous candle, and it shows indecision in the marketplace, but more than that, it's also a train track formation. We've had the market moving up strongly and then moving down strongly. And we also have that as a reversal bar formation from buyers, signified here by the white candles, becoming sellers as shown by the black candle there. So we have three things. We have the reversal bar formation, we have the train track formation, and we also have the inside candle formation. And that's just from the price action front. We also know that this is a horizontal level where we're expecting price to move to the downside. The way that we look to enter this position would first of all be to put an entry point underneath the low of that candle, less a few pips. And we put our stop loss behind the swing high here to make sure that we keep our stop loss as safe as possible. We'll make sure that, of course, is in the normal red for the stop loss, but we can see the blue being the entry and the red as the stop loss level. The fact is that we can see that we then get another inside candle here, which of course means that this first order was not actually triggered. Now, all of a sudden, we're in a position where you've got extreme indecision, shown by the double inside candle formation, and we've got that at a level where we're expecting price to show indecision and also reverse positions, or reverse directions. As a result, we'd move our entry order underneath this inside candle, or this double inside candle formation. We keep our stop loss nice above the highs up here to stay safe. Our entry point's aggressive, and our stop loss is to the safe side there. We can see that this engulfing candle next actually triggered the order and entered us into the trade, and then ran to the downside. Now, when you're looking at time frame correlation, you need to understand that we're not looking to get into the trade on the daily chart and run the trade on the daily chart. What we're trying to do is get into the trade on the daily chart, which in this case is the smaller time frame, but actually manage the trade on the higher time frame. As a result, we're letting the trade breathe and move a lot more because the expectation is that this is going to move a lot longer over a slightly longer period of time. If we move this along a bit further, we can see, of course, the price was actually moving sideways for the next few months. Now, over the next 2 months, we can see this was a sideways marketplace. We could have captured several hundred pips here on the daily chart and said thank you very much. 200 to 300 pips, roughly speaking, which all in all is not a bad result from having a stop loss of around 100 pips. Certainly we could have seen a 2 or 3 to 1 reward to risk trade. The thing is, a 2 or 3 to 1 reward to risk trade in a daily chart is a solid reward to risk. So a lot of people would be tempted just to take the 2 or 3 to 1 reward to risk. That's it, wait for the next opportunity. And there's nothing particularly wrong with that. However, bearing in mind that we want to work as little as possible, or trade as little as possible, to make as much money as possible, the idea here on this time frame correlation approach is to enter the marketplace on the dailies, but actually run the trade on the weeklies. So all of a sudden now we jump to the weekly chart again. We've got our entry and our stop loss in here, but we can see that we're much more likely to run the trade quite a significant distance further. We can just make out the blue entry point there and our 100-point stop loss. And with our 100-point stop loss there, we'd be looking to run the trade to the downside. Now, if we use the stop loss of the double seller bar and put our stop loss behind the highest high of the last 2 seller bars, we can see that seller bar 1, seller bar 2, our stop loss still remains up here, 100 pips. Seller bar 1, seller bar 2, our stop loss actually would be able to move then across to this position. Seller bar 1 and seller bar 2, of course, the stop loss stays in the same place. Seller bar 1, seller bar 2, we can start to move the stop loss down. So this is not a short-term trade because we're looking at the dailies and the weeklies. We could quite easily be looking at the daily charts for the actual trade setup, but entering the trade on the 4 hourlies instead to just give ourselves a slightly shorter time frame of trade. But we can see through here now that with all these seller bars, our stop loss is going to be able to move down significantly in our favour, and all we're doing here is managing the stop loss once a week at most. So it's hardly a huge amount of work involved with regards to managing the stop loss once a week. Seller bar, seller bar, seller bar, seller bar, or seller candles, bearish candles through here. We then see bearish candle, we'd be in a position to move the stop loss once more. Bearish candle, we'd leave it where it is. There's one more movement to here because of the two bearish candles following each other here. And finally, towards the end here, these two bearish candles at the bottom, we can move the stop loss down to around this kind of a zone. And we can see that's where we then get stopped out of the position, and that would be our exit point. Now, looking at this now in pips terms, we know that we had a 100-point stop loss. And we also know that on the daily charts, we'd have made about a 2 or 3 to 1 reward to risk. However, now we're looking at the weekly charts. This trade's made in excess of 1,000 pips. Suddenly your trade that was 2 or 3% is now looking at 10%. That's a drastic difference between 2 or 3% return and 10% return from a one trade. Now, of course, this isn't just something that happens all the time, but it is certainly something that when you're looking at several different currency pairs that you can quite happily take advantage of. We've seen this first example now, and we're happy with this one. We're going to now just move some of these lines out the way and clean the charts up a little bit. We're going to focus then on the next opportunity which we found. That actually comes into play around here, which is where the support level actually then became resistance. We see support becomes resistance. This is actually the zone we're looking at through here. The market on the weekly charts is in definite downtrend, and we'll focus on this area now and see what opportunities there were to enter the trade on the daily chart. So now that we're here looking at this daily chart, we can see that price action actually came up to this level several different times. First of all, we had a big gap over the weekend here, where the market closed here, gapped up, and closed down again. This was down to the Spanish or Greek banks. And it's not something we'd actively look to trade off of, purely because it's such a huge fundamental piece of news with the Spanish or Greek banks defaulting on that weekend in particular. We wouldn't really be looking to derive any price action signals from that. The next thing we see is price comes up and gives a doji. And almost exactly the same thing happens again. We get another big gap up and a big move down again, and this was exactly the same as the weekend before. Over a case of 7 days, we had two big banks defaulting from Spain and Greece. So again, there's nothing we could particularly take away from this price action here, as it was hugely fundamentally driven. Now, if we take a look now at the next one, we see an inside candle, and it's a bullish candle there, so we wouldn't really be looking too closely into this. And we see a big seller candle, big bearish candle through here, and the market starts to fall away. Over this period, there's no real price action signal that tells us that the market's likely to move lower there. So we wouldn't actually really be doing a huge amount. In fact, it's not until the market comes back up to this level again for the third time would we be really interested. And the reason for this is simple. First of all, we can make out this head and shoulders pattern that's developing on the charts. We can see here that we have ourselves the first shoulder. We then get to see the head forming here. And the really crucial part of this is now we have ourselves a lower low. And equally important, the lower high. We have that shift in cyclicity from the upside now to the downside. And while we had no price action signals these two previous times, we now have ourselves a very strong bullish move up to the level, followed by a very strong bearish move down again. Now, it's not really what we'd call train tracks, but it's a solid inside candle formation there off the level. We can see buyers tried to push it through the level, and sellers turned around and went, nope, not going through. And we also have the cyclicity on our side, helping us believe this market's moving to the downside. As a result, the way that we look to trade this would first of all be to put our stop loss behind the swing high. And our entry level in this case would be underneath the inside candle here. We'll just make that blue so it's more visible. We can see the entry underneath the inside candle, and we can see the stop loss above the swing high here. And again, we wouldn't look to trail the stop loss on a daily chart. We'd be expecting this move to run for some distance, so we'll be looking at the weekly charts in this case. Now, of course, we can see this trade did not run a particularly huge distance, but our stop loss was in the region of about 125 pips, and we'd have probably made around 200 pips from that trade. Again, a positive reward to risk trade, nothing massive there, but still a solid reward to risk that's positive. And the third one for us to look at here now is actually where this support becomes resistance again. We can see how the support level here of this descending triangle was broken, and we can see these strong bullish candles pulling up to the level that then act as resistance. If we now take this golden box and zoom into it, we see now that we're on the daily charts, we see the level, we see the price action at the level, which interestingly enough here we have lots of bullish candles coming up to the level. Suddenly you have a bearish candle here, which gives us the reversal bar formation, but we also have ourselves a bearish pin bar. We can see with this bearish pin bar, we'd be looking to have ourselves an entry point underneath that bearish pin bar, because a bearish pin bar obviously signals a change in sentiment, and we have the reversal bar formation there as well. We'd also be looking to put our stop loss behind the swing highs up there, just to keep it safe. So our stop loss is a small red line, and our entry point would be the small blue line. And again, we're not looking to trail this stop loss off of the dailies. We'd be doing it on the weekly charts, because we'd be expecting this to give us a strong move to the downside. Now, as it happens through here, we can see, of course, it doesn't give us a hugely strong move. But if we just look at the move to the downside, we can see that by managing it on the weekly charts, we haven't really had to do a huge amount of work, and yet we're still going to end up with some profit out of the trade. We can see here we have the bearish candle, the stop loss stays up here, bullish candle, and our stop loss would actually end up moving down to just above that inside bullish pin bar there. So our stop loss would be moving down to around this kind of a level, and you can see here this would not have been a huge winning trade, but it would still have made some profit to the downside there. So nothing major, but we can see there out of 3 potential opportunities, we've had one that's made a small win, one that's made an average win of about 1.5, 1.8% to 1, and one that's made 10 to 1. Suddenly we're looking at around about 12% profit from 3 trades, which is not a huge amount of work for a very healthy return there. And we also notice now, because we've seen this market's put in the higher high, and actually then the higher low, we start to say to ourselves that there might be reasons then to look at trading this to the upside. If we clear everything on the chart now, and just post this level here back in again, we can see we have this support that becomes resistance, that actually then becomes support once more. The interesting part here is, in the downward trend for the last year or so, we've had significant lower highs and lower lows all the way down. Suddenly now when we get to this level, we have ourselves a higher high, which is our first warning signal, but actually the higher low as well. Now when we have that potential trading opportunity, and we can drill down and look at the daily charts. Just highlight this zone, and drill down and look at the daily charts to look at the potential entry opportunities at the level there. And sure enough, as we see it, we zoom out a little bit further, we can see we have ourselves price action pulling down to this level, and this level actually gives us a very strong price action signal to the upside, here being the bullish pin bar. If we failed on that bullish pin bar, we had another bullish pin bar, another bullish pin bar, and another bullish pin bar. So we had several opportunities to get into the marketplace here, plus a reversal bar formation and an inside candle. So we've got a lot telling us that the market is likely to move up. First of all, we'll mark our stop loss. We'd have our stop loss just behind the low of the bar there. And our entry point would be a few pips above the high of this daily candle. Of course, the entries in the blue and the stop loss there in the red. And as always, we would not be looking to trail this stop loss on the daily charts. We'd be looking to trail this stop loss on the higher time frame, trailing it on the weekly charts. If we trail the stop loss on the daily chart here, we can see it's very likely that we made some small profit, or actually if we use a double buy bar formation here, we'd actually have ended up losing around 35 points. Our stop loss is around 70 pips. We'd lost about 0.5% if we traded it and trailed our stop loss off the dailies. However, giving it room to breathe and cycle and looking at the weekly charts, we suddenly start to see that while our entry point would have been down here, we'd have managed to run this all the way up to underneath these bearish pin bars up here, which would have resulted in a profit of around about 400 odd pips. And 400 odd pips, of course, with the 70 pip stop loss, gives us around about a 6-to-1 reward to risk trade. Very high reward to risk and very little management there. That's the really beautiful thing about this time frame correlation, particularly if you're doing it on the higher time frames like the dailies, weeklies, and even the 4-hourlies as well, is that you can get into the trade and actually managing it over the following weeks. We do very, very little management and actually let the trades run and move in our favour, locking in significant profits along the way. And now that we see that 6-to-1 trade through there, we'd also have one final look on this euro dollar, where these resistance levels actually then act as support. So we can see through here how when the market was in downtrend, we were using support becoming resistance as reasons to get into the marketplace. But now we've got resistance becoming support in the upward trend. This is the way we're going to look at the market in the upside. We see price pulls back down to the level here, and if we zoom into that now on the daily charts, we'll just highlight the area to look at. And if we look at it on the dailies, we can start to see how, looking around this area, there's some very interesting things on the chart. First of all, we see how on the daily chart we've got resistance becoming support, also of course being the same on the weeklies. And we have ourselves a reversal bar formation. We have bearish candles becoming a bullish candle, and we have our brilliant bullish pin bar formation there as well, which I'll just put the arrow underneath. We can see that bullish pin bar that we'd be looking to trade. Now that means that our stop loss here is going to be around about 100 pips, and had we trailed this on the daily charts, we'd actually had quite a few stop loss movements, but we'd have been making around 170 pips of profit. We may actually still even be in the trade. But certainly we've allowed the trade to run to the upside, and we've made some profit from this daily chart trade. On the weekly charts, of course, we're quite happily in this trade. It's running in a very good profit right now. I would expect to be somewhere to the region of about 500 pips in profit at this point in time. We can see, of course, there's less trading signals when we wait for this time frame correlated approach. However, because we're looking for such big moves, the reward to risk is so heavily in our favour when we do get them right, that this is a very sensible and structured way of trading, where we actually put in very little work for a very good return. We put little time in for a huge return for the time invested.